Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner Hari.
Hello.
Welcome to the second part of Sherwin Williams. This episode, we are going to do a deep dive into their financials, the management, and the valuation. All right, let's get started.
Yeah, this episode was literally like watching paint dry. So I'm sure everybody's as excited as Becco and I are to talk about paint. So, but I'll probably give a disclaimer first that we are the Value Investor TV podcast, and we are not financial advisors, nor do we know your specific financial situation. So please consult with the appropriate advisor before making any financial decisions.
Excellent.
All right, so we were talking about Sherwin Williams, which if you haven't heard of them, they make paint. And in the previous episode, we had kind of talked about that their competitive advantage seemed to focus on their brand and a well-known brand for almost 140 years. We think that they have a pretty strong competitive advantage because there isn't a lot of competition in the paint space, and they seem to have a dominant position in the North America region. And we don't think that they're growing very much just because, the paint market is only growing at about inflation. But we don't think that they require a lot of capital to maintain their business. And the only thing that we're concerned about potentially is that, there's a regulatory hurdle that they have to keep clearing if the EPA or states change the regulatory environment. So that kind of summarizes where we were. We're going down our checklist that you can we follow on every one of our podcasts. You can reach us at info@valueinvestor.org and get that that checklist, or join our Slack channel and chat with our other listeners. Okay, so going back to our checklist, Becco, we had talked about the capital reinvestment. How do we translate the moat that we talked about, which was a brand, into return on capital? Do they generate a high return on capital?
Yeah. So again, this is pretty top of mind for us because we just recorded a podcast on return on capital, the importance of return on capital. So let's just revisit that topic here with this company in mind. So in 2019, if we look at return on capital employed, you're getting about 14%, return on invested capital about 11%. But you have to, again, this is why we emphasize that you have to look at multi-year statistics. You have to look at these numbers in a wide, in a broader window than just a single year. If you do that calculation back from, say, 2011, 2012, 2013, and onward, you'll see something quite interesting. That number, return on capital employed, went up all the way up to 44% in 2016. 44%, which is really respectable for a company that makes paint. You wouldn't think that, right? But they make really good high returns on capital employed. But what happened in between 2016 and 2019? It dropped from 44% to 14%. And again, revisiting the formula, return on capital employed is EBIT on the top. And what you do on the bottom is you subtract total assets minus current liabilities to get capital employed. What happened was the bottom, the denominator really shot up really quite high. And the reason for that is because they acquired a company. They acquired a big company for about $11 billion. And so the total asset went up from $6.7 billion to about $20 billion. So the denominator really went up while the numerator didn't increase as much as the denominator. Therefore, the ratio return on invested capital didn't stay at 44%. It came down to 10%, and then it slowly rose up to about 14%. So right now it's sitting at about 14%.
And with that acquisition, which lowered their return on capital, did can you tell us a little bit about that? Like what was the reason for buying it, and or who was it, and what was their logic?
Yeah. So they bought this company called Valspar. Valspar.
Okay.
Are you familiar with them?
Yeah, I
Art?
mean they're one of the big competitors in paint. So that seems to, I think that answers my question, but go ahead.
Yeah, they bought them for about $11 billion. To swallow a company like this, they had to take a lot of debt.
Okay.
They had to take a lot of debt, in fact. So in 2016, their long-term debt was under $2 billion, and after the acquisition, it went up to about $9.8 billion. So quite a substantial jump in the debt
Okay.
area right there. But and we'll talk about this in the subsequent questions. But they've been doing a good job consistently of paying down the debt. So it peaked at $9.8 billion in 2017 as soon as they acquired the company, and they've been slowly paying things off. So now it's sitting at around $8 billion in debt. This is only long term debt, right? We're not talking about leasing and things like that, just long term debt. And if you look at the top line growth, it was at around $11 billion when they acquired the company, before they acquired the company, and now it's sitting at around $18 billion.
So pretty big
So
jump for them in terms of revenue.
yeah, exactly. It was a huge jump. It was pretty steadily growing at around 11 billions, around 11 billions for a long time, for 3 years, 4 years, and then it jumped to 14, 15, and then now 17, almost 18.
Okay. Well, while we're talking about the financials, let's ask a few more questions about that. Does the company have enough cash to maintain its business?
Yeah. So to answer that question, we look at current ratio as well as just the debt level and how that relates to the free cash. So if you look at the current ratio, it's consistently been around one. I mean, right now it's sitting at exactly at one. So in terms of short-term cash requirements, I think they're doing okay. In terms of straight up cash on their books, they have about 160 million dollars on their books. So not a lot really for a company like this. 160 million dollars just sitting in cash for a company that does about 18 billion dollars in business top line. So cash cushion, not there isn't much. I mean, if I look at this, it went down to, like, in 2014 they only had around had only about 40 million dollars in cash cushion. So I would like to see that number go up a little bit, but that's that. And if you look at the free cash flow to debt, we want that ratio to be below 3, right? So you're able to service and provide, not only service but really pay off the principal amount in 3 years, right? And the ratio that I get right now is 5.2. And before the acquisition, they were quite good. It was 1.8. So they levered up quite a bit to swallow this company. But again, the good thing is that ratio peaked at 2017 at 6.3 and has gone down to 5.2.
So what was their pre-acquisition of Valspar? What was their free cash flow?
Free cash flow was pre-acquisition about $1 billion.
Okay, so
And now we're talking about 2 billion. So they doubled in free cash.
So they doubled their free cash flow with the acquisition. So they paid $11 billion to get an extra $1 billion per year. Is that a fair measurement? So I mean, that's not terrible. I mean, in terms of and it takes a competitor off the market. So okay,
but that's free cash flow, right? That's the better measurement. If you look at the price, PE, it's about 28 billion, or sorry, 20 PE of 28 rather. Sorry.
Okay.
Because the revenue jump was the net income jump. Before acquisition, it was again around $1 billion, and after the acquisition, 1.5. Okay. So modest increase of $400 million in net income with the acquisition.
Okay. Well, let's keep we're going to talk a little bit about management here to see, this company has, it sounds like it has generates solid cash flow, but it may not be. We'll have to see how it compares to their market cap in a minute. But let's first of all, since this company is not really growing, let's talk about management and what are they doing with our cash. But first, is management properly incentivized to protect shareholders' interests? And since this company is 140 years old, they're probably not run by their founder. But is there anybody that has a significant portion of his or her wealth associated with Sherwin Williams?
Yeah, so this is where I get really excited, actually. If you look at the executive ranks, many, many, many are old timers, lifers with this company.
Okay.
For example, the CEO joined the company since 1984. That's CEO. He's also the chairman. CFO joined since 1990. SVP of corporate controller joined since 1989. SVP of HR joined since 1983. So these are pretty old timers who are running the company, and I suspect that their wealth is pretty much tied to the company, unless obviously they come from big money or something like that. But I suspect that they have a lot of their wealth tied to the company stock. So, as you mentioned, this is not a company that's recent. They've been around 140 years. But I think this is as good as it can get in terms of executives.
So can you tell us a little bit about how their compensation structure is for Sherwin Williams?
Yeah. So yeah.
Yeah, for the CEO specifically.
The CEO, so 90% of his comp is stock based, and the performance metric they look at is share price, EPS, and there's one more thing that I didn't write down, but there was one more, and I need to do a thorough research before I tell you guys anything. But when I glimpsed at it, I thought that they could have done a better job of pegging their performance to financial health metrics, meaning things like like ROIC, for example. As we mentioned, ROIC, dropped from 45% to 14%. If they included something like that, I think that could have been nice as well.
Do you think that since they seem to be pretty asset light before, are they going to slowly divest of Valspar? The assets that Valspar has to just kind of get them under, to be more capital light.
Yeah, exactly. I think that was the intent. So I looked at their press release back in 2017 when they acquired this company. This is exactly what they said. Sherwin Williams expects to achieve $320 million of annual run rate synergies in the areas of sourcing, SG&A, and process and efficiency savings within 3 years. The company also expects this transition to be immediately accretive to earnings, et cetera, et cetera, et cetera. But yeah, so bottom line, $320 million of annual runway synergy in the areas of sourcing, SG&A, and processing and efficiency savings.
Okay. Well, so not necessarily a red flag, but it could be better on the management incentive structure. But let's look at their capital that they've been, what have they been doing with free cash flow? Are they doing buybacks, dividends, a little of both? Is there anything we should know about that?
Right. So one of the things that I begin to look at is this ratio, right? And I talked about this with McDonald's. It's this ratio of total shareholder return divided by free cash flow. So the total shareholder return is just summation of dividend and then stock buyback, and divide that by free cash flow. And you want that number to be below 1, right? You want people to be doing these things with free cash flow so that you don't tap into the lifeblood of the company. So if you look at that number, it's been consistently below 1 for the most part. I mean, you got 1 year that blipped over one, but mostly it's been under one, which is good. If you look at the actual amount, absolute amount, dividend, they consistently been paying out dividend. Last year, they paid out $420 million in dividend and stock buyback of $624 million. And what's exciting about this is that, again, going back to the income statement, if you look at the earnings growth, again, this is one of the classic examples of shareholder cannibal. If you look at earnings growth over the last 13 years, earnings grew at around 13% compounded annual growth rate. If you look at EPS, that grew at around 16% annually. You might think that 3% is no big difference, but if you compound it over 10 years, it actually can lead to a pretty sizable difference. And that's what you get with this company. EPS grew from, let's see, back 10 years, 2010 was $4.25 per share, and it's now EPS of 16, 17. So going back to your question of share buybacks and how they've done it, this is what they've done.
Okay, so they've got a, and they've also paid a dividend in that time, which could have been honestly better suited for doing buybacks, depending on the price. But
Yeah.
the overall return would be higher also because of the dividend payment too.
Precisely.
Yeah, so it's
Yep.
not just the 13%, but you would be getting a cash payment as well. Okay. Do you see any red flags as far as the management's communication? Do you think that they're open and honest about how they communicate with shareholders?
Yeah, as far as I can tell, no red flags that I can see from here.
Okay. Well, then let's just move on to the all important question. Are they cheap enough for us to buy? So can you give us your estimates and what you think Sherwin Williams is worth based on what your assumptions are that went into that?
Mm-hmm. Yeah. So let's take a look. So initial free cash flow of about $2 billion, and I estimated the growth rate to be, again, this is with buybacks and everything else. So one thing about buyback that I want to comment is that during COVID-19, they sort of paused the open market share purchase during the second quarter because they thought it was appropriate to reserve cash in case of downturn, things like that. But now I think they're giving it another look. Starting in third quarter and fourth quarter. In fact, they just reported a pretty good return on the last quarter. They just reported it last week.
Yeah.
So I think they're going to resume buyback. Okay. Having said all that, because of that, I think the growth rate, we can say it's going to be about 15% for the next 3 years. And I said that it'll come down to about 13% and then 10% as the terminal growth rate. And then, so discount rate, again, we always use 10% for discount rate. If you run the numbers, you get intrinsic value of about $250. Again, as you guys know, if you've ever done discounted cash flow, you can really fool yourself with these complex calculators. But that's the assumption, right? 15% growth rate in the first 3 years, 13% 3 years after that, and then 10% after that. And after that, you get about $250 per share. Right now, it's trading at $650. PE of 30.
Yeah, and about the same in terms of free cash flow or price to free cash flow, so about 30.
Yeah.
So it's not cheap by any stretch of the imagination.
Not cheap. Exactly.
And I think there's also some issues there that at some point your free cash flow is going to have to go to paying down the debt. They may have to sell some assets in order to get. I would like them to sell some of those assets. Maybe that'll help pay off some of the debt. But you have a lot of money that's is going to generate interest and so forth that you have to worry about. So to me, it seems like. I would like to see them at substantially lower price because you're not going to see much in the way of top line growth long term. So
Yeah.
any growth you're going to get is through share buyback.
Yeah. Exactly. Yeah. And just on the note of the debt, they don't have any substantial amount of money due until like 20, well, I guess 2022.
Okay.
Yeah, they have about 700 due then. Yeah. This year they have about 400 due, but they've been paying off debt pretty, at least for the past 3 years, pretty consistently.
Yeah, but it's also money that you're. I mean, 400 million would be nice to have in your pocket, right? To, or to be used for dividends and buybacks,
Yeah.
and now it's being spent on
Yeah.
debt payment. So
Hmm.
you essentially traded, money now for a longer term, hassle. And I think honestly, it wasn't a bad acquisition. You paid 11 times cash flow for it. But you still have, you're still going to have some significant amounts of debt to pay down.
Yeah. Yep. 11 or yeah, something around there. So it wasn't a bad one. I think it's now time to digest it, make sure you divest some of the assets and make it more streamlined and things like that. So,
Well, and if we were to, get it, if the stock price were to plummet, below that margin of safety price, the one thing I would be concerned about is that if management goes and makes another acquisition, with debt, that would be the big concern for me. It may be beneficial, it may help with cash flow, but the biggest risk to me is, you bought Valspar for 11 times earnings, you're trading at 30 times earnings. So to me, you would have to be buying this company at, 5 or 6 times earnings for it to be cheap relative to what Valspar, a very similar company would be, right? So, it's not so easy for me to see that as a, this will take a significant drop in price for it to get there.
yeah. I mean, yeah, especially with the intrinsic price at this point and then, trading price at 600,
Yeah.
2 times more, 3 times more. One thing that could be interesting is if they issued, if they sold more of their shares out in the market because it is, well priced,
Yeah.
they could pay down the debt that way.
That's certainly an option. I think it would be feasible to do that. I think the biggest thing to me is that this company is just overpriced right now, and if they were to make an acquisition, I think they could potentially do it with shares also, right, instead of
Yeah.
using debt. So same thing.
Yeah,
But
exactly.
anyway, I think the interesting things here, simple business. It's as you mentioned in the last episode, if you're new to investigating companies and 10Ks and so forth, this may be a great business for you to start with. I think on that list is also Skechers. NVR was a very simple business. Southwest Airlines is kind of a simple business to understand. A little more complicated is Southwest, but Sherwin Williams sounds like a good starter company to start with, and
Yeah.
do your own homework, go through the checklist, and find out.
Yeah, exactly.
Okay. Anything else you want to add, Becco, before we close out?
No. Oh, I guess one kind of interesting fact. During COVID-19, people have been painting a lot.
You're at home all day, so you got nothing else to
Yeah.
do, I guess.
Yeah, people are picking up their own, their projects that they've wanted to pick up a long time ago, and now they finally have time to do it. So people are out there buying paint and things like that.
Yeah,
So it was a
breathing in the paint fumes, in their
yeah,
at home.
that's exactly what they want during COVID.
Yeah.
Anyway, yeah, it was a boon quarter for them. So
Yeah, I mean, it's interesting which businesses have kind of done well during COVID. Tech companies and Sherwin Williams. Other companies like McDonald's got hit pretty hard. Disney is getting hit really hard because of.
yeah,
So a lot of things are shifting here. So, but and you would think the airlines would be hit harder than they are, but they've seemed to mostly be back to normal in terms of stock price, but not revenue.
Yeah.
So yeah, we live in interesting times. I think there are a lot of companies that are like Sherwin Williams that are trading well above their value, and it's going to be interesting to see what happens when the market finally understands, or tries to price these correctly.
Yeah. Exactly. Anyway, interesting company. Encourage everyone to look at it, especially beginners. I think it's a good company to start with.
All right. Well, last thing I'll leave you all with is if you would like to interact with us, get this checklist, or join our Slack community, please email us info@valueinvestor.org. We'd happy to talk to you, answer your questions, invite you to our channel, and interact with all of our other listeners. So thank you very much for listening. We really appreciate it, and we'll see you on the next episode.
Thanks, everyone.